out there, and I think India is the play. When you look at where the US is, it's certainly too high. We've got earnings there which are close to bubble.com earnings, 25, 26 times. That does worry me. And China still has some problems. I think India does represent certainly a better bet over the three of them if I were to invest for the long term. And remember, that is a long-term type of projection. We'll see a lot of volatility, but I think India is certainly better placed there.
Right. Thank you very much, Jonathan. We'd love to chat with you longer, but slightly short of time this morning. Hopefully we'll catch you soon and you have a good evening. Well, there's Jonathan Barrett telling us about his views. He's constructive silver. He does believe it's a great proxy to play gold, and with its recent catch-up that we've seen with a 6% gain last week, there's still some more room to go on silver. And as obvious, he did indicate that while crude is reflecting lack of geopolitical stress, it's gold that is very much rallying up on back of rising geopolitical worries. Across equities, he believes China's rally is unsustainable. India still looks good despite being expensive. Well, now let's move focus back to India, and it seems like we should be getting a flat start. Could be a morning of consolidation. 24,850 to 25,000 is the playing range, with Bank Nifty being the key driver in today's trade on back of a bunch of earnings that were reported. But let's start with a few earnings, and then of course we'll continue to talk about those through the course of the next hour and a half. Tech Mahindra reported numbers. Numbers were good. I think we're done with all the earnings from the IT pack, and there were a few standouts, Tech Mahindra being one of those. Profits were up 46.8% to come in at 1,250 crores versus 851 crores. Other income has spiked significantly, and we got to understand what that other income is. Up 261% to come in at 520 crores versus 144. Revenues, just like the other large cap IT players, came in single-digit growth, 2.4% at 13,313 crores. Dollar revenue up nearly 2%. EBIT grew 16.2%. Margins have also expanded. So apart from Emphasis, the other company that's posted an expansion in margins happens to be Tech Mahindra, coming in at 9.6 versus 8.5. New deal wins have grown significantly at $603 million versus $534 million, and TCV growth also looking quite healthy. But like all other tech companies, the management commentary continues to remain cautious about the outlook for Tech Mahindra. But all in all, earnings were good. It's a thumbs up in terms of what brokerages seem to believe. Well, the other one that has managed to impress the street is HDFC Bank. It's up until last quarter's earnings, there was disappointment, there was lack of sort of catch up or the recovery turning the corner around for HDFC Bank, but that very clearly seems underway now. HDFC Bank reported profits that were up 5.3%. Net interest income has improved to 9.9%. Gross NPAs have come in at 1.36 versus 1.33. Net NPAs have climbed to 0.41 versus 0.39%. Provisions have dropped to 2,700, and I think that's what the street is taking heart from, down from 2,602 crores quarter on quarter. They've also officially and formally announced that they're looking to sell 10,000 crores worth of shares of HDB Financial Services, a large part of that already in the price for HDFC Bank. They will also complete the sale of 91% stake in HDFC Education for 174 crores. It seems like loose change given the size and the market cap of HDFC Bank, but an important update coming in from the management. The other one I quickly want to highlight before I toss it back to Agam is MCX. The stock has been one of the top bets for most people betting on the long-term story of India. It's been reeling under a little bit of pressure. The counter did gain sharply on Friday afternoon, trading at a record high. And the numbers were good. Profit was up at 153 crores versus a loss of 19 crores in the same quarter last year. Revenues were up 74%. EBITDA came in at 179 crores profit versus a loss of 28 crores that was seen in the same quarter last year. And margins have also improved significantly. So this just justifies why the stock trades at a record high and gained pretty well on Friday.
Yes, absolutely. Well, moving on, we also take a look at Tata Consumer Products. It does seem like the numbers are ahead of street expectations because we're looking at revenue growth around 13%. We've seen an expansion in its EBITDA margins coming in at around 14.9%, up an improvement of around 50 basis points. And net profit has remained flat at around 367. This is largely on account of one-offs. But it does seem like the commentary has been very, very mixed from the management standpoint, because they are suggesting the India beverages has been hurt in the second quarter due to competition, and they're expecting overall margins to stay flat. You know what, while they have beaten expectations, this stock has dropped below its 200 daily moving average, and that is going to be important. It's going to be a wait and watch whether or not we actually see a recovery, because it has been on a downtrend. It's going to take a bit before it actually starts seeing a little bit of recovery. I'm not certain if the earnings today will actually take it back above those crucial levels. But moving on, we have an update from ICICI Lombard. Again, you know, sequentially, year on year, the numbers do look good, but they are looking at an increase in their combined ratios. When it comes to the gross premium, we're seeing about a 20%. About 10% growth on a year-on-year basis. Your PAT has also seen a 20% growth coming in. 10% growth coming in. What stands out here in this case is your combined ratio, which has seen an increase of around 2.2% on a year sequential basis, and year-on-year as well. It has moved up around 0.6, and that could be something of a concern. Even on a sequential basis, we've actually seen a decline in its gross premiums as well as earned premium. So that's going to be something that markets may not exactly take to positively. Let's move on and talk about India Mart Intermesh. Again, a stellar quarter coming in for the second straight time, and we're looking at 18% growth in revenue, margins expanding to a whopping 38.7% against 27%, and we have net profit doubling on a year-on-year basis. So a lot of that has been priced in, because we've actually seen a lot of strength as far as India Mart Intermesh is concerned. So keep an eye on that one. The final one on my radar is JSW Energy, where it has acquired 3 renewable power assets from a hetero group, and this is for a sum total, or rather an enterprise value of around 630 crores. So it will be interesting to keep an eye on this one as well. Samina.
Yeah, just to add to that list very quickly, Oberoi Realty reported numbers. Revenues were up 8.5% to come in at 1,320 crores. EBITDA was up 27.7%. Margins have improved significantly to come in at 61.66 versus 52.34. Net profit was up 29% to come in at 589 crores, and they've declared a second interim dividend of 2 rupees per share. So all in all, good sort of earnings coming in from Oberoi Realty. The stock should see a positive reaction to that. PC Jewelers, the stock member has been raging in the last couple of months now, largely on back of higher gold prices. Now, whether or not that's impacted earnings is what we will look at. Profit stood at 178 crores versus a loss of 138 crores. So again, good set of earnings. Markets will like what they see. The counter did see a decline in trade on Friday, but today could be an important day for the stock. Revenue has grown 12.5%, and they've managed to drop their finance costs not significantly. They dropped significantly to 1.6 crores versus 123 crores. So a big improvement operationally, and of course the fact that their revenues have also grown in double digit ahead of the festive season is what could keep the stock up and about in trade. Just 2 more quick updates that I have is GM Financial. And this could be a positive morning for GM Financial. The RBI has lifted restrictions imposed on GM Financial products early this year, which was a material subsidiary of the company with immediate effect. So watch out for GM Financial. You will see the stock reacting well to that. You also have Godrej Properties. They've acquired 3 acres of land in Ahmedabad with a development potential of 0.9 million square feet of saleable area. And it's a big order win for Garden Reach, which has won a contract worth 491 crores from the Ministry of Defence. Do we have anything else, Agam? I think there's a whole bunch of more earnings that we're covering.
No, well, I guess that it's time to perhaps take stock of HDFC Bank and how the street is watching this one. So we do have Pranav Gundalapalli. He's a senior research analyst at Bernstein, who's joining us on the show right now. Pranav, good morning. Thanks for taking the time out. Let's start with your view on HDFC Bank. Well, more pros and cons this time around.
Yeah, so I think going into the earnings over the weekend, I think what was known was the weak loan growth. I think we got that from the headline numbers, but all the incremental information I would say was largely positive. I think NIM staying flat despite the reduction in LDR, and borrowings not declining a lot was a positive. OPEX growth moderated again, and also fee income growth, I think, came back after a pretty weak last quarter. And most important was that we didn't see any increase in credit costs or a pickup in slippages, something that we've seen for some of its peers as well. So I think overall a positive set of numbers, not a lot of surprises, and that whole ROE improvement thesis seems to be well in place, and balance sheet normalization ROE improvement thesis seems to be intact. So say a good quarter on an absolute, and more importantly on a relative basis rather than an absolute basis.
It's also Samina joining in, and it's a complaint. You've taken extremely long to come back and talk to us, so you should be talking to us more often. You called out the recovery on HDFC Bank maybe a quarter back, right? And it seems like things are falling in place for the bank. What do you think is not working for HDFC Bank, or what needs to work for it to completely do the 360 change?
See, I think there is a normalization which is underway, and it will take time. I think that LDR normalization seems to be a top priority for the management, and therefore weak growth is known. What will help the bank, I think, is an environment where the credit growth slows, deposit growth picks up, and if you throw in some asset quality deterioration, then yes, I mean, that will make it the perfect environment for the stock to really outperform. But from an operating metrics perspective, I think most of the requirements are largely in place. I think it's only a matter of time that they fix the balance sheet, which is get their LDR below 90%. And from there on, I think they should see their growth on par with peers. And until then, what we look at is their deposit growth. As long as that growth delta versus peers of the system is intact, I think the whole thesis remains quite intact.
How glad are you that the provisioning has been kept at 2,700? I mean, while the industry struggles with it, interestingly, HDFC doesn't seem to have too much trouble around that.
I think that hasn't been a big surprise because they have hardly grown in the last 4 years in the non-mortgage retail segment. So if you look at peers, most have seen, even the largest bank in the country has seen about 25% growth in the non-mortgage retail segments, whereas HDFC has seen only about 10% growth over the last 4 years CAGR. And that means that if there is any deterioration in asset quality, they would be the least impacted. So the asset quality shining is not a big surprise. I think the quality deteriorating for peers is where the relative difference starts to kick in.
1684, would you still go long on HDFC Bank? What is your target price on the bank in the near to medium term?
Yes, so we have a 12-month target price of 2,100, and we think them showing a few more quarters of that normalization of balance sheet should drive the upside there. And in terms of risk from here, I think a sharp slowdown in deposit growth is really the big risk that the bank faces. Not just for itself, but for the system-wide, a slowdown in deposit growth, to me, is the biggest risk that the bank currently faces.
All right. Pranav, let's move on and talk about Kotak Mahindra Bank as well. We were expecting pressure, and it does seem like the earnings have not been up to the mark. But what is your analysis here?
See, I think this was a quarter where the bank part of the Kotak entity disappointed. This was the first full quarter post the embargo, so I think that pressure was very visible. They did manage to deliver on growth. The overall loan and deposit growth was quite strong at 15%, but it came at the expense of margins. So the NIM continued to decline almost 11 basis points Q1Q, driven largely by a forced shift towards the secured businesses. And I think the bigger concern for us is the increase in slippages. Now, Kotak's, the reason why investors have loved Kotak is their phenomenal asset quality trends over the last 10, 15 years. So any further deterioration on the asset quality, I think, would be a big negative. So far, I think it can still be categorized as normalization. But anything further from here, I think, would put that conservative premium at risk for Kotak.
Just taking a cue from what you said, the credit slippages is become a problem for Kotak. Do you feel like this is an early indicator of what's to come for the whole sector? Because Kotak is probably one of the best, or rather best in terms of being risk-focused in that sense.
Yes, I think that's what they've been, known for in the past. The only caveat here is that some of the businesses where they're seeing stressed credit cards, for instance, are areas where they've grown recently. So it would be probably not fair to extrapolate their past credit underwriting outcomes into the newer segments. And there is also a certain seasoning of segments that always needs to happen, or portfolios that needs to happen. So, yes, there does seem to be a sector-wide stress in the unsecured loans book, unsecured loan segments, and Kotak has, at least if this quarter is any indication, is not immune to it. Now, whether how they fare versus the broader sector, I think we'll have to wait for the next weekend to see. I think once ICICI and SBI come out with their numbers, I think then it becomes much clearer as to how they fare versus the broader market.
What can we expect in terms of resolution? Some timelines the management may have indicated when it comes to, its credit cards department, the challenges there?
I don't think there's any timeline that management has put forth. I think they are still working in terms of making the necessary changes, the investments required. They have an auditor on board to ensure they are on the right path. But I think wholesale tech changes of the nature that RBI seem to highlight, I think will take some time. And I think the appetite for the higher yielding products does seem to be there because they've just bought Stan Chart's portfolio last week. So once it resumes, I think we will see them come back into the PL and credit card segment. That might help the margins front, but the timing seems to be quite uncertain at this point.
Again, Pranav, your rating on Kotak Mahindra Bank as well as the fair value that you're putting it at this point?
So yeah, we have a market perform on Kotak. We have a target price of 17.50. Now, unless we see a big pickup in their deposit accretion, especially the low-cost deposit accretion, we think that growth premium that they've had in the past is at risk. Therefore, we're not too bullish on the bank until the RBI embargo lifts and we see a clear improvement in their liability franchise.
All right, Pranav, we'll leave it at that. Thank you so much for joining us and giving us your perspective on those two very large private sector banks. Of course, we'll be watching out for the reactions coming in this morning after its earnings. But from there on, we move on to the primary market action. And we have yet another well-awaited IPO coming up. That's Waaree Energies. And of course, Deepak Builders, which are set to open for subscription today. And Samina is going to take us through. Well, Waaree Energies first, is it, Samina?
It is, and Agam, you're right, it is going to be a blockbuster subscription. I'm not even going to say listing, because they, a few weeks ago, lowered their price band significantly to what the unlisted price was. So it's, of course, coming in at a discount, which is going to be a huge positive, at least in terms of the interest it's going to garner from investors. But very quickly, the subscription opens today, closes on the 23rd of October. It's a fairly large size IPO to the tune of 4,312 crores. The price band is in the range of 1427 to 1503. The company will list on the 28th of October, and they've already raised 1,277 crores through their anchor book. The grey market premium, even before the subscription opens up for retail investors, is at 105, which is closer to its unlisted price of 1,565. Now let's tell you what they're going to do and what the subscription is about. There is a small portion of the fundraise, which is an OFS to the tune of 721 crores, and they're doing a fresh issue of 3,600 crores. Anchor investors that came in were big names, marquee names, in fact, and foreign players. So you had Nomura, BlackRock, Mirai, Lighthouse, Nectar, Bloom, VC amongst others. So you had a couple of private equity guys, and you've had a couple of sort of global marquee investors who've allocated to Waaree Energies. Well, what is Waaree Energies and why the excitement around this one? With the big focus and push to renewables, this becomes a very good play into the sector. They are a leading solar module manufacturer, and they own 20% of the domestic market share. The company was set up in 1990, so has a fairly long legacy in terms of existence, and they also operate 4 manufacturing units with a capacity of 16.66 gigawatts. Fully utilized at this stage. So any of the or large for the funds that are being raised will be used for expansion of their facilities, which will go into Odisha. It's a huge expansion plan that they've lined up for themselves to the tune of 9,050 crores over the next 3 years. 2,775 crores of the 3,600 crores being raised will be invested in this Odisha facility. Financials were also rather impressive. So the company has been doing well and picking up growth quite significantly in the last 2 years. What we have from the DRHP is their revenues have jumped to 2,854 crores in FY22 to about 11,397 crores in FY24. EBITDA is also up significantly at 1,574 crores from a mere 1,111 crores in FY22. You also had their margins improving significantly. So their margins were at 3.9% in FY22, now at a huge bump up there at 13.8% in FY24. Profits, as you can tell, have also grown significantly, coming in at 1,274 crores from 79 crores in FY22. Well, in terms of strength and outlook, their future looks extremely robust, driven by the ongoing capacity expansion, addition of new capacity in Odisha, or very healthy order book, and the growing demand for renewable energy. With the rising global sort of solar energy demand and India's focus on renewables, this company becomes a great proxy to play the whole theme. What you want to be a little concerned about, if there are any risk one watches out for, 100% of their order book comes in from the government. So that is the only risk that Waaree Energies has. Their order book is not diversified in the sense of private and government players. It's largely, or rather only, government focused. So that's the only thing you want to keep in mind. And the fact that they have quite a large dependence in terms of US exports and Chinese raw materials. So that's a concern in terms of Waaree Energies. Any sort of delays from Chinese raw materials or US not picking up as much could impact the earnings of the company quite significantly. So that's what you have for Waaree. There's a lot of excitement around the subscription. Remember, it comes in at a deep discount to its unlisted price and hence trades at over 100% premium in the grey market. So that is Waaree. That's the big one. You've also got Deepak Builders, a very small sort of subscription as compared to the giants that we've seen recently. This one opens today, shuts on the 23rd. The IPO size, like I said, is 260 crores. Price band is in the range of 193 to about 203. They raised about 78 crores for their anchor book, and the grey market premium is also available on this one at 52 rupees higher than the subscription price. Well, they have fresh issue of about 217 crores. Promoters are marking a small exit of about 42 crores. So some money will be, of course, be in OFS, but it's a rather small chunk to the big sort of IPO. In terms of fund utilization, 112 crores will be used for working capital, 30 odd crores will be used for the payment of debts. The finance cost in the next quarter will, of course, ease off as we expect. Well, what is Deepak Builders? They're an infrastructure EPC company. They build railway bridges. They also undertake redevelopment of railways. Beyond that, they also construct hotels, schools, hospitals, etc. The company has a pretty healthy order book at 1,380 crores, of which 66% comes from railways. Numbers are healthy. In FY24, they've posted a revenue of 511 crores versus 433 in the previous year. Net profit also came in at 60 crores, a pretty big jump from the 21 crores that we saw in FY23. Margins have also improved significantly at 22.98 from 12.2. So the last 1 year, the growth has been pretty robust and significant in terms of up move. Well, the risk, like I said, there's geographical concentration. 33% of the order book or the business comes in from Punjab, so very state focused in that sense, and of course the dependence on government orders. So that's what we have for Deepak Builders. It's a small IPO. The big one clearly is Waaree Energies, Agam, but interestingly, both of them are trading already at a significant premium in the grey market. So some excitement around both of these.
I can only imagine the excitement considering the grey market premium. But let's talk about the futures and options space now. And, I was mentioning the rough sort of range that we are expecting the Nifty to hover between is potentially 24,500 on the lower end and 25,000, 25,100, 200 on the higher end. And, this is based not just on certain technical parameters, but also the way we're seeing a lot of these traders position themselves when it comes to the options market. As far as the futures is concerned, we're looking at unwinding coming through. Last Friday on the Nifty futures, The Bank Nifty futures saw unwinding, which was a lot deeper. In fact, 14% decline in open interest when it comes to the Bank Nifty futures. We move into and talk about the options market, and at the moment, we have a substantial amount of calls being written at the 25,000 mark, and on the lower end, it's largely 24,500 is what we are keeping an eye on in terms of puts. Now, when it comes to stocks, again, it's been a day of a trade where there was a lot more weakness. And even though, the close for the Nifty was higher than its open, we did see a lot of selling in individual stocks. So you had names like IGL, L&T Technologies, MGL, Crompton, all of them looking at shorts. And on the other hand, in terms of stocks which are unwinding, Havells, Dr. Lal PathLabs, L&T Finance, as well as M&M Finance did see a bout of short covering, even though their spot didn't advance by substantially higher. But L&T Finance, of course, will be in focus today as well, as will names like HDFC Bank, Kotak Mahindra Bank, and Tech Mahindra too, on account of earnings in the futures and options space. But on that note, let's get in our experts for today. Well, we have Kush Bora. He's the founder of kushbora.com, and Soni Patnaik, she's the AVP at GM Financial Services, who joins us on the show. Good morning to both of you. Thanks so much for joining in. Kush, how are things looking at right now, keeping in mind what we've seen last week?
First, a very good morning. Yeah. And let's hope that this week turns out to be a little better than the last one at least, right? Look, broadly speaking, Nifty's been in a range. At least on a closing basis, we saw that Nifty maintained the 24,700 support zone, and on the upside, we're looking at a 25,200 kind of a resistance band. Now, broadly speaking, the Nifty is still in a no trade kind of a zone. The bias may seem a little bearish right now, a little towards the negative side, but as long as 24,700 on the closing basis is maintained, you wouldn't want to perhaps go out and short because closer to support zones. But again, you don't even want to go long because very close to the support zone, any kind of breach of that, and then you're seeing 24,500 on the downside. So Nifty for me still remains in a no trade zone. So that's the one that will monitor for those key levels. On the upside, 25,100, 25,200, those are the zones to look for. Once we are in the clear from these levels, that's when a new long trade kind of can be looked into. On the flip side, Bank Nifty is looking quite exciting. While the Nifty had gone on and broken the recent lows, on Friday, the Bank Nifty is held on very comfortably above those levels. Now, 51,000 and thereabouts, will act as a good support zone. So if you do want to consider a long trade, Bank Nifty is the index to look at. 52,500, 52,800 are the immediate, targets to look at. 51,000, little deep, but that's the kind of support zone on the stop loss that you want to keep. And HDFC Bank, posting good numbers for sure will help its cause.
Oh, you're right. It's going to be a difficult week, but hopefully it's been 3 weeks of cuts coming in on the index. But Bank Nifty has been a standout, especially with the kind of reporting we've seen over the weekend. Soni also joins us with a technical view in the market. Soni, good to have you this Monday morning. What are you feeling? It feels like the Nifty range has moved lower, right? 25,000, which was acting as a key support last week, now becomes a key resistance on the Nifty. Bank Nifty, though, stood out with a little bit of outperformance, looking far more comforting than the Nifty, I would imagine. But your trade on Nifty and Bank Nifty this week?
Hi, good morning, everyone. Thank you for having me on your show. I think rightly pointed out, Nifty has seen 25,000 now acting as a strong resistance. Any move towards that level, unable to cross above 25,000, will continue to see some selling pressure from those resistance level. On the downside, 24,700 was acting as a support. It broke on Friday. It saw a new support, a new low of 24,560 odd level. So I think that's the level to watch out for as the next support is concerned. The trade in Nifty remains more of a sell on rise structure. There's no short covering bout seeing in Nifty as of now. Strong call writers around 25,000 levels. So any move towards that level may see some bit of a selling pressure. It's only depending on Bank Nifty that may act another day as a savior. And, Bank Nifty has seen a strong move above 52,000. The short covering on expected lines has been triggered above 52,000. There's a possibility that Bank Nifty may head towards 53,000 level, which is the next strike where call writers have positioned themselves. So there's a possibility that Nifty may remain in a range only because of Bank Nifty's strong short covering move. So I think that's the index to look out for. In Bank Nifty, one can look for a buy on dip sort of a structure. There's good support of 51,500. So as long as that support is getting defended and held, one can look for buy and dips in Bank Nifty and look for higher targets of 53,000, but that will be on a positional basis and not an intraday. For Nifty, it's best to avoid right now. It's in a no trade zone. However, if it approaches 25,000, one may look for a sell on rise. So this diversion in Bank Nifty and Nifty is quite visible, and that's the index strategy to follow.
Point taken. But let's also get in Dharmesh Kant. He's of Chola Securities. Dharmesh, good morning. Naturally, my first question will have to do with your assessment on what you make of HDFC Bank and Kotak Mahindra Bank. How do we move forward on both these big names?
Yeah, good morning. Agam, the problem with the numbers of Kotak Mahindra Bank was that it was not to the expectation. It was a slippage overall, whichever parameters you looked into it. At the same time, the guidance was also a weaker kind of a guidance, where they guided that unsecured portion of the lending is facing, kind of a slowdown. It's likely to continue for this quarter as well. Q4 is where things may likely to improve. HDFC Bank was more or less in line with the numbers, but see, a bank which has been used to 20-25% kind of a PAT growth is now coming down to 5-6% kind of a PAT growth. And management themselves said that it will take time before things fall into place. The rise in deposit growth is good news, but at the same time, it's a liability for you. The cost is being added to the P&L, and that is where the problem lies. So I think both the banks will underperform in today's market. You may have some 2%, 1% kind of up move on HDFC Bank, but it won't be a trending or a wealth creator buy as of now. So I am a bit skeptical on the entire space seeing these two numbers. Axis was good, but again, they were cash in Axis because the trading income was higher because they booked most of the trading gains. If you strip that out, even that was a normal kind of a number, nothing great out there.
Sony, I noticed one of your buy calls this morning is India Mart. There's a good possibility the counter gets a gap up because the numbers were phenomenal. You want to take our viewers through what should they do in the case if it gets a gap up?
Certainly. So I think, Samina, last week itself, the way India Mart was adding long positions, open interest was very heavy. Even in the last 2 days, it has added approx 14% open interest. So that was indicating that India Mart, anyway, with the support of 29.50, 29.70, gets defended and there's a closing above 3,000, which it did happen on Friday. You can see the move above around 3,200. So any possibility that it gets a gap up around 3,100, which is like approx 2 to 3% from current levels, then there's a possibility one can continue to add longs in it. You can see it for heading to higher targets of 3,200. If it even crosses 3,200, there's a likely even higher possibility that it can test 3,260, 3,300. So those are the levels to watch out for. But of course, the first target is going to be 3,200. In any case, keep a strong stop loss of 2,970 from where it has been defending with good put writing position base, as you can see. So I think that's the level to watch out for.
What will you do with banks this morning? HDFC, Kotak, Axis, and a whole bunch of mid-cap reportings like an RPL as well. Any long trades constructive on any of those banks?
Definitely. Private banks have seen a good bout of move on the upside, but the stock that has actually held on to very good levels would be ICICI Bank. So above 1,220, it has been continuously holding to its levels, even though when the markets were choppy and correcting, it never broke below that level. It has seen a strong close as of Friday above its 20 EMA hurdle. So ICICI Bank continues to be a strong buy even at current levels. It can test 1,300, 1,320 levels. Any small declines towards 1,250 to 1,240 range would be a good buy accumulation zone. Keep your stop losses strict at 1,220. Look for higher targets of 1,300, 1,320 levels. So I think this is the first stock to look out for.
All right. Well, let's get Kush's calls in as well. Kush, Torrent Power is a very interesting, and I believe that's one on your radar. What else are you tracking right now?
Sure. So given the texture of the market today also, we've got a hedge strategy in place with a long and a short call on the long side, as you rightly mentioned. There's Torrent Power. We know the stock has done phenomenally well over the course of last 2, perhaps even 2.5 years. Right now, it is near that resistance zone of 1960, closed just above that on the back of fairly decent volume. So, from the cash segment, Torrent Power is a buy. This could continue. This momentum could continue up until 2020, 2070 levels. On the downside, you're looking at a stop loss at 1920. On the short short side, BHEL rather, has gone into a bit of a near-term downward tizzy. 300 was a resistance mark. It slipped from there. Now 250, is a level that it's trying to hold on to. But I have a feeling that, with the kind of momentum and the volume that we are seeing on the downside, there's a possibility that this could well be breached. So on the downside, you're looking at, a 251, 247 kind of a target. And the stop loss is at 260. Mind you, this is for the October futures expiry.
Sony, you've got one more long trade. You want to take our viewers through that?
Second pick is in Jubilant Food. Now, Jubilant Food also has been holding on to a very good support of 600. On Thursday, it witnessed good short covering. On Friday, it added some more positions. So I think that's the level. It's just adding positions. It's seeing a good defense around 600. So Jubilant Food remains a buy from current levels. On any small decline up to 617 can also be the range one can accumulate the longs. Keep a stop loss at 605 and look for higher targets of 650 to 660. So the reversal has come in very strongly from 600 levels. The short covering is in place. Put writers base as in place. So I think these parameters are adding that a positive outlook may continue in Jubilant Food up to 650, 660 levels.
Okay, there you have it. That's the view on Jubilant Foodworks. But let's get in Mihika to give us a list of more stocks which are on our radar on the back of earnings. Mihika, over to you.
Good morning. So up first we have Tejas Networks, a strong set of numbers. EBITDA grew 42 times on a year-on-year basis. Net profits have seen a turnaround to 275 crores versus a loss year ago. The turnaround was due to strong revenue growth, mainly by the India private segment, where revenues grew 13 times on a year-on-year basis. Growth was due to the ramp up of 4G as well as 5G radio access networks for BSNL, where the company shipped wireless equipments for over 58,000 sites. Up next we have Dalmia Bharat, where the company's missed estimates on all fronts. EBITDA is down 26.8%. Margins have contracted to 14% versus 18%, and net profit saw 60% degrowth. Now, earnings were mainly impacted by two factors: weak cement pricing and muted demand. However, the lower revenue degrowth was due to the 8.4% uptick in volumes, and EBITDA per ton was down 32% on a year-on-year basis to 650 rupees. Then we have Mangalore Refinery and Petrochemicals, a bad set of numbers. While revenue did rise 26%, the company went to an EBITDA loss of 474 crores versus a profit of over 2,000 crores a year ago. Net loss stood at over 1,000 crores. Now, the earnings were impacted by weak refining segment globally. Gross refining margins contracted to $0.55 per barrel versus $17 a year ago, and EBITDA was also impacted by 4 times higher changes in inventories of over 2,000 crores. We have Lloyd's Engineering. Revenue was up 74%. EBITDA also gained 32%. Margins did contract to 15%, but net profit was up 48.8%. The revenue growth was driven by execution. The company's order book is now standing at 1,366 crores, which is almost over 2 times its FY24 sales.
Thank you for that, Mika. We'll come back after a quick break, but just before that, a quick check on how implied Nifty is doing this morning. Trading rather flat when we opened the show at 8 a.m. Not much has changed since then. We'll take a break. We'll come back. We'll put the focus in pre-open and also continue chatting to our guests. So stay tuned. Welcome back. You're watching India Market Open. Implied Nifty indicating to a flat start in early trade this morning. It's going to be a morning of consolidation, so no surprises there. Sony, a couple of stocks in the tech pack that I want to talk to you about. Tech Mahindra earnings were better than expected. Wipro did a pretty sharp move on Friday, and Infosys moved down by 4%. How would you trade the three tech companies I mentioned in early trade?
So, Samina, if we first talk about Tech Mahindra, it is still consolidating. There's good support around 1670 to 1650 range. There's resistance around 1710. Any fresh upside in Tech Mahindra should only be now considered if it's able to cross the 1710 mark, above which it can test 1740 odd level. So I think that's the level to watch out for. If you look at Wipro has seen a short covering move. It's closed above the 540 resistance mark. So I think that's important to watch out for. Immediate support continues to be at 530. However, 570, 575 is in immediate resistance. So there's a range for Wipro to play around from 530 to 575. Any move above 575 can see it heading towards 600 odd levels. I think these are the two levels to watch out for.
Okay, well, let's get Dharmesh in for his view on a bunch of other names as well. Dharmesh, over the course of the weekend, we've had a lot of earnings coming through. Any of these that you're tracking, any of these names that stand out for you?
Not really, Agam. I mean, we were expecting Q2 to be a muted quarter, and to our surprise, the numbers have been a bit more muted than what the expectation was. So a lot of earnings came through, but nothing, attracted us to initiate a buy or something like that. Even from a short-term trading perspective, based on just the valuation comfort being out there. So looking out for, a few more companies, particularly from the banking and BFSI space, how it comes around. Otherwise, if you look at, say, almost consumption stocks, they were not good. FMCG basket was, weaker. Even Pebbles, Polycab, and KI came out with a good set of numbers. So that was, the commentary was also strong because input prices are hurting there. So that's likely to continue, seeing how the copper prices are panning out in the international market. Reliance was again a degrowth set of a number. So, nothing attractive as of now. What is, catching attention is the defense-related stocks. And there we are very bullish on Hindustan Aeronautics. So we have reinitiated our buy call on that and from 1 to 3 years kind of a perspective. And our sense is by next 3 years, by FY27, the EPS reported by them would be 220. So it's available at 20 times P multiple with margins improving to 27%. So it's a buy on every decline kind of a strategy out there, HL.
Kush, you want to comment on some of those consumption names? They've been on the sell side all through last week. Nestle reported earnings that disappointed the street, unfortunately. As we go into trade this week, do you feel like stocks like at least Tata Consumers and Nestle, Godrej Consumers, ITC could witness a bounce back and hence may not be such a bad idea to go long on these stocks?
Well, more on optimism rather than anything else, and the reason being that if you look at the kind of fall that these stocks have been witnessing, at best a stock like Tata Consumer has witnessed some sort of a short covering bounce, but something like a Nestle, not really there. Some of these have actually broken below the support zones. So I'll perhaps be a little watchful. There's a good possibility that as could be the case with Nifty as well. Some of these consumption names might see a sell on rise kind of a setup. So I'll be a little watchful. Anyone looking to buy these from a medium to a long-term perspective, that's a different story. But from a near-term trade perspective, I think they still look weak. Tata Consumer, if it does cross above that 1100 mark and if it sustains above that, then perhaps, you can consider a long trade. But a lot of these names, otherwise are still seeing a lot of pressure. There could be a case of sell on rise in some of these names going forward too.
Sony, what are you doing with MCX this morning? It was at record high, spent the early part of last week consolidating, if I may say. Friday saw sharp up move. Earnings have been fantastic. This morning, if you get a gap up, would you buy into that gap up?
So, Samina, MCX has been in a very strong uptrend. However, the gap up shows a very strong move towards 6,800 odd levels. I think it's wise just to wait for a while and see if it is continuing to hold above a 6,600 mark, because that is going to be the next level of support if this gap up were to sustain. Only on those dips one can look to reinitiate a long and then again look for targets. But definitely on a positional basis, the stock is heading towards a 7,000 plus mark, and most likely in October series itself, the levels can get tested. So I think that's the level to watch out for, anywhere between 6,600 to 7,100 odd levels.
What about Siemens? That was another stock that was going out with very aggressive buy calls. And Kush, I'll come to you because you called this out on Thursday, I think. Stock did really well. And then towards the end of trade, it began to ease off. But from where we stand today, does Siemens looks good for a fresh long call, you think?
It does actually, and I think the level at which it sort of hit the low 75 or 7600 thereabout marks is actually a support zone. So if you want to initiate a long trade, I know it's a little deep-ish kind of a positional support zone, but as long as 7500 7550 is held, I think from a near-term perspective the long trade is on. Also what we've seen is that there's a lot of traction in some of the peers as well. So even something like an ABB was doing rather well. So Siemens does continue to remain a buy for us as long as 7500 is maintained. On the upside, at 8000, the level that we discussed, and 8250 are the targets to look at. So yes, a bit of consolidation is healthy. On the whole, the trajectory is north. Any kind of dip should be taken as a buying opportunity in Siemens.
All right. Well, that's your view there. With that, let's move on and take a look at perhaps we can actually take up something like the realty space with Dharmesh Kanta, or actually we'll wait for it. So we have JP Morgan, which initiates a coverage on India Cement, and Mika is now joining us to give us more details. Mika, good morning.
Good morning. So JP Morgan has initiated coverage on some of Indian cement counters, namely 5. They've initiated a coverage on Ultratech Cement and ACC with an overweight rating, and the target price for Ultratech Cement implies a 24% upside, while that for ACC implies a 32% potential upside for the stock. They also initiated a neutral on Ambuja Cement and Tree Cement, and the target prices for both imply a 3.3% upside for the counters, whereas for Dalmia Bharat, they've initiated coverage with an underweight. Even the Q2 results for the company were weak as expected, and they missed all estimates, and the target for Dalmia Bharat implies a 15.7% upside. Now, they do prefer Ultratech Cement for a better EBITDA per ton. It is key to know that Ultratech Cement will be coming out with its Q2 results today, a weak quarter expected, but EBITDA per ton is expected to contract the least. For ACC, the company has underperformed, and this has led to the company trading at lower EV to EBITDA valuations, which can be a beta trade in the near-term revival as per JP Morgan. Now, a little bit about this Indian cement sector, where JP Morgan states that the sector is set for consolidation and urbanization, as well as infrastructure projects will boost the medium-term cement demand in the country. They also expect the utilizations to remain stable despite the aggressive new capacity additions that we have been seeing coming on stream, and they do expect a recovery in the demand, which was muted for due to the monsoons, and they expect this to rise because government capex is expected to grow around 40% year-on-year post the monsoon season.
Right, so you've got cement and JP Morgan on cement companies initiating coverage on counters such as Ultratech. A quick check on how pre-open is doing this morning. It's a flat start, so largely in line with expectation. In fact, there is a slight positive bias in pre-open trade. Inching closer to 25,000 is what we should be getting as we gear up for trade this morning. Bank Nifty may potentially be the star again this morning. A positive reaction on the likes of an HDFC Bank cannot be ruled out. Kotak, on the other hand, could see some pressure, and that's what pre-open trade is indicating to. Tech Mahindra earnings were good, so that stock again will see a positive trade play out. But just very quickly, those are a few counters we've talked about. But Sony, you want to come in on metals? Anything in metals that you're buying? With the Chinese stimulus that came in on Friday, the metal index rebounded quite well. And I would expect the gains to continue this week. Any preferences on the metal pack?
I think, Samina, the entire sector would be a wait and watch for me, because on Friday we've seen some of the metal counters, metal stocks, sort of break their support levels. Just a wait and watch. Only stock that I would be looking for today would be Vedanta. Now, Vedanta has some call writers present around 485, 490 strike prices. So if the stock is able to cross above these levels, sustains, the call writers could be seen exiting from the position where Vedanta can retest its previous highs of 510 plus levels. I think that's the level to watch out for. And also provided, if the put writers are finding a base around 475. So that these two strike prices and this level, these stock would be very important to watch for now.
Dharmesh, are you tracking the primary market closely? If yes, what is the verdict coming in on Vari Energies and Deepak Builders?
See, worry we have, covered closely, and we should have noted on that. So this is a clear buy. I mean, it's a thematic buy from a long-term perspective. Though the IPO size is small, so I'm expecting listing gains to be very high on this. That is a trend which has been followed up. But even for investors who are looking to be in this space, renewable energy space, and the entire segment to which it caters for, say, 3 to 5 years perspective, then it's a huge potential out there. It's a leader in the space as well. So there we have buy note, and we would be looking to FCons, which is scheduled for this week. Again, it would be a subscribe, but today they have an analyst meet. We'll go through the details, and then the verdict would be there on that part.
Dharmesh, come in on names like MCX. Then, of course, we have something like a BSC. And of course, we're also waiting for NSE to eventually list. I don't know when it will happen, but over the course of the next few months, it certainly will. How are you placed when it comes to some of these exchanges now?
Yeah, I mean, if you're looking at these places like BSC or probable listing of NSE, CDSL and all, so it's not, one should not be looking at them from even a decadal wealth. It's more of a generational wealth creation kind of a concept. If you look at the demat account, so 60-70 crores is what is being said. But if you look at unique demat accounts, I mean, same individuals may have multiple demat accounts. It's less than even 50% of that number. So extrapolating that, you have multifold opportunities out there for next 10 years, 15 years kind of a time frame with volumes, everything going up. So I see their earnings maybe from 10 years down the line going up by, say, at least 5 to 6x, if not 10x. And that is the potential they are sitting on. Near term, 1 year, 2 year perspective, 100, 120 kind of a PE multiple does look scary, but from 10 to 15 years time frame, they are not, and that's the reason why there's a huge interest in these companies from FIIs, from very ultra HNI clients. They are just acclimating it, and there is no sense of any taking profit or trading profit out there. So the advice is to be invested and stay invested for your kids, not for yourself.
Tech Mahindra is expected to get a good start this morning. And I'll look at MCX as well, because this could also be another stock to track in early trade. 1.5%. So it's no runaway rally on MCX. Kush, but you want to come in on Tech Mahindra, 3.5% in pre-open trade, followed by Infi that's also managing to find a base after a 4% fall. And Wipro as well, not looking too bad. Would you consider a long strategy for the week on any of the tech names I mentioned?
Well, our picks still remain, the likes of Persistent, Coforge and HCL Tech. With that, Tech Mahindra, with this kind of a gap up, I think, the bulk of the gains to be made today, or at least in the next couple of days, is perhaps done. So from a risk reward standpoint, it will not make sense. So you might want to take some money off the table, for Tech Mahindra at least. Correct. But the near term trend for this one is fairly bullish. So, if you have an existing position, book partially, hold the rest. That's not an issue, but not for today, in the sense initiating a fresh trade, not for today. As far as Wipro goes, I think, Samina, this is your I told you so moment. And you've been asking questions about Wipro. I think there's been a good consolidation on this one coming around. For me, 550, 555, that zone remains a bit of a supply pressure. If that is taken out, I think, a move towards a 575 cannot be ruled out. So steady, not a big momentum play on Wipro. But if someone's in for this for, let's say, a month or two, perhaps a little longer, then Wipro is something that you can consider, because there's a very good base formation around that 525 mark. So Wipro is something that you can consider. But as I said, our picks remain HCL Tech, Persistent, and now Coforge as well.
Right. Dharmesh, a quick view on Tech Mahindra. Earnings have been strong, but it also seems like the management has been very conservative when it comes to commentary.
Yeah, I mean, on business outlook, they are conservative, but if you look at the way they are, hiring people and taking people at higher levels, lateral and vertical recruitment is very high. And Europe has improved quite significantly. If you look at Eurozone GDP growth or the UK GDP growth, that has been picking up, which augurs well for this company. The only part is the valuation part, where it has run up too high. So I think, there won't be a selling happening out there. There won't be a correction. But upsides from here, I think, would be limited. Most of it has been captured. So if you are already invested, stay invested. Fresh buying, one should wait for one more quarter.
Right. Thank you, Dharmesh. Good talking to you this morning. That, of course, is the word coming in fundamentally on the markets. Contrary to how implied Nifty was playing out in early trade, we are setting ourselves up for a good start, and opening around 25,000 is what is expected in the next 40 seconds. Sony, very quickly, 30-second answer, top pick of the day.
So the topic of the day would be HDFC Life, which has seen a good strong close above its 20 EMA average. It's also looking at a good strong gap up. So one can buy HDFC Life with a stop loss of 730 and targets of 765, 770 for the day.
So HDFC Life is Sony's top pick. We'll come back to Kosh at 9:20 and get his top pick on market opening. Actually, I've got another 20 seconds. Kosh, you want to try this? 10-second answer?
Absolutely. Previous speciality, the stock's been on a tear, opening, gap up, but for a target of 1850 and higher, that can be considered. On the downside, you're looking at a 1725 as a stop loss. So from a near-term and a medium-term perspective, both.
Oh, well, those are two trading calls coming in right at top of market open. A start at 25,000 is what we're expecting. Stock of the morning should be Tech Mahindra, if I got this right. The Nifty 50 just shy of 25,000 on the screen. 24,962 is what we have. Bank Nifty is looking good, and it's been on a good run last week as well. So good earnings from the likes of an HDFC Bank and Axis on Friday is what's supporting Bank Nifty. 300-point up move on Bank Nifty is what we have. One of your key contributors in terms of how Nifty is performing. A quick check of how the broader market universe is trading and what's happening with other sectors. Whether or not metals are doing well early this morning, the broader market's performing in line with the benchmark. So no major outperformance in the mid-cap and the small-cap or the micro-cap index just yet. Sectorally, the WIX and also the WIX is what we take a check on. The WIX after a fall last week is seeing some up move. Maybe a little, may not be too bad, could be healthy in terms of what we're seeing on the WIX. 3% higher is what we have. Like I said, metals could be a sector to track today. China, of course, lowering its prime lending rate on Monday, and that $100 billion impetus coming in from the Bank of China is what's helping metals on, and we are seeing that commodity prices on the LME are looking good. All sectors are trading positive, barring private banks have also turned positive. FMCG has had it rough for the last couple of weeks, continues to trade lower in early trade this morning. A quick check of where the action is, and real estate looks good, finance looks good, metals though leading the pack. We expected this. Tech Mahindra is the stock of the morning, 2.5-3% higher, followed by HDFC Bank. The street is impressed. Commentary is positive. All that put together means that HDFC Bank continues its rally from last week into this morning, up 3%. HDFC Life was the top pick from Sony. The stock is already up 1.5%. Wipro is the one that I've been tracking, another 1% being added to Wipro, despite the fact that there are no major cues on the counter this morning. Metals are looking good as a whole pack on back of the way the LME commodity prices have been doing. On the sell side, weak numbers, and Tata Consumer takes it to the chin, 5% off on that one. Markets clearly not being kind to anybody that's disappointing. Kotak Mahindra down 3%, Bharti, ONGC, OMC is trading flat, but the action, Agam, as expected, is Tech Mahindra and HDFC Bank on the upside this morning.
Yes, certainly a very interesting market right now. We're also going to take a look at the broader markets right now and see how things are faring and whether or not they are in fact outperforming the benchmarks. They aren't. In fact, they're just a tad below on a relative basis. Mid-cap and the small-cap indices advancing by around 0.2% to 0.4% respectively. But let's take a look at some of these earnings and the stocks that how they've come through, at least in terms of opening. So we're going to talk about a handful of strong earnings firstly, and it's followed by IndiaMart Intermesh, but that's locked in a 10% lower circuit, and I wonder why. Of course, there's got to be something more to it than just the earnings, because we are looking at strong set of earnings there. But perhaps we are certainly, we have to take a closer look as to why this has happened right now. MCX also down 0.8%. Good earnings coming in, but it does seem like it's at very heady valuations. And of course, Oberoi Realty is the other one which is advancing by as much as 2% at the moment. Again, moving on, we also have Lloyds Engineering, which hasn't really reacted right now, but NetWeb Technologies is up around 7.5%, and Punjab Sid Bank also advancing by around 1.5%. Moving on, in terms of other news makers which are in focus, we have GSW Energy signing 3 SPVs. We have Godrej Properties as well with an update, and Reflex Energy up as much as 2%. So all in all, well, it does seem like a day of trade where we see more advances as compared to declines, and the benchmarks are currently trending higher. IndiaMart Intermesh certainly, a curious one, Samina, for now.
Yeah, we'll get a view from Sony as well because she was constructive and long on the counter, but a 10% downtick cannot be good news for the stock. A quick check of the broader markets as well. You've got a whole bunch of other counters that are trading higher and lower. In terms of gains this morning in the Nifty 500, you've got Tejas Network. That stock is up 20%. So big up move coming in on Tejas Network on back of earnings. The stock has hit upper circuit, trading extremely well. NetWeb Technologies reported numbers. The numbers were good. The stock is up 8.5%. Mazgaon Docks, after, of course, selling off last week on back, actually, no, that was Cochin Shipyard. Mazgaon Docks did well on Friday, continues to see a very sharp up move of 6% in trade. Garden Reach, I highlighted for you that they've bagged an order for 491 crores, and that means the counter is up 4%. Tata Chemicals is also trading with a 5% gain. Numbers were okay. They were weak last week, but the fact that they're seeing an improvement this quarter is what the markets are taking heart from. Amber Enterprise is the other one that's looking good. Tech Mahindra looks good, 361 RAM gaining ahead of its earnings later on in the day. UTI Asset Management, UCO Bank trading with a 3% gain. Zomato is looking good, and so is BSC. A quick check on Oberoi Realty as well. They reported numbers today, so did MCX and so did PC Jewelers. Oberoi Realty, as expected, up 2.5%. MCX, I guess, cooling off after a strong performance last week on Friday. PC Jewelers, good numbers. Finance costs has dropped significantly for this one. The counter seeing a good up move of 4% in trade. On the sell side, PNC Infratech, that remember these were the stars of last week on back of big order wins from the Maharashtra government. This morning down 13%. That's a big cut. It's pretty much given up everything it gained in the early part of last week. India Mart down still 10%. RBL numbers haven't gone down well with the street. The counter sees a very bad cut of nearly 10%. Tata Consumers looking good. Mangalore Refinery, the GRMs have declined substantially. I wonder if this is what is going to happen to the rest of the pack as well. But the counter gets a thumbs down, 3.5% lower. Elecon Engineering, we'll talk to the management shortly on earnings. The counter is trading 3.5% lower. Kotak Bank, 3% off. Mastech on earnings down 2.5%. Manappuram, HEG, V-Guard are some of the other two big losers. L&T Finance also seeing a cut. Sony, you want to comment on India Mart? What just happened here?
Right. So I think it has not tested the levels we were hoping for, and it has broken above below the 200 EMA. So there's a sell or maybe a book profit sort of a situation that we can see. Important is that it is still holding above the 2700 mark. However, 2800 level where the 200 EMA lies, it has broken below it. So that may just now act as a resistance. So I think the buy remains only if it tests those levels, and if it's able to cross the resistance, then it becomes a buy, or else as for now, one can avoid it. And it's just a reaction to the results, and the profit booking has taken place on those lines.
Right. Well, on that note, going to thank both our experts, Sony and Kush, for joining us and taking us through their views on the markets, and of course, helping us with a bunch of trading calls too. But let's get in Sameer Bhise. He's the Managing Director and Co-Head of Research at BFSI and GM Financial Institutional Securities. Sameer, good morning and thanks so much for joining in. Sameer, we are talking about financials in general, specifically banks, large banks which have come up with earnings. What is your overall assessment for all the private sector banks which have already come out, and what are you making of them?
Yeah, hi, good morning. Thank you for having me on the show. So we have been slightly circumspect on the overall financials as a sector, primarily emanating out of two drivers. One is obviously growth is slightly slower, led by the deposit challenges that the system continues to see. Also, we are entering a phase probably since last 6-9 months, wherein credit costs will normalize. And specifically some pockets, which is unsecured loans, will see some bit of high credit costs. So companies which are more exposed to these kind of segments may see some bit of volatility in earnings. And that continues to play out. I think this quarter, from whatever numbers we've had till now, was no different. You've seen credit costs go up for unsecured segments, tepidness in overall business momentum, and also a bit of margin pressure, though probably slightly less than what we had seen, say, 6 to 8 months back. So that's the backdrop we are operating. I think in this context, some of the large private sector banks we continue to like. They have reasonable cushion on balance sheet with respect to excess provisions. They have reasonable cost of funds advantage, as well as a diversified loan book. So that way, I think large private sector banks are relatively better placed. Our preferred picks are ICICI and Axis. Yeah.
Before we talk about how well Axis did on Friday, let me get your view, Samir. It's Samina joining in on Kotak. Are you disappointed with what you saw? Because the street seems to be.
Yeah, I think there was a bit of a disappointment, primarily driven by the fact that the margins declined worse than peers, which was slightly surprising. And also the credit costs, especially slippages, went up on a sequential basis. So we have a hold rating on Kotak. I think that stays. Having said that, Kotak still remains reasonably high ROA bank, though some of it may be under pressure in the quarters to come. But yeah, I would call it slightly a weaker result, if you ask me.
Right, but you still maintain your call on Kotak, which is a hold. Would you add more?
We have a hold rating, yeah.
Would you add more in today's weakness? The counter is down 3.5%, 4% as we see it.
I think the outcome on result, I think we haven't changed our target price meaningfully. Neither is the rating, so we would stay hold here.
Concerned are you about the overhang by the regulator? Because until that goes away, there's a good possibility that Kotak will reel under pressure. And secondly, also credit card slippages. I mean, this is a bank that's well focused on risk. And to see them seeing slippages here could be an early indicator of what the industry is going to see in the next quarter?
No, I think industry is already seeing it, and Kotak is also part of the same trend that we are witnessing across most banks. So it's not as if it's a harbinger. I would say that it's an industry-wide trend already, and that is also reflecting in Kotak's numbers. And about the RBI embargo, yes, all eyes remain focused on how it shapes up and when it is lifted. But I think it is still some time away. That is what we understand on the recent disclosures.
Okay. Well, as far as some of the relatively smaller PSUs are concerned, Samir, how are you reading into what we can expect going forward as well, and anything that stands out for you?
So I think in PSUs, we have a buy rating on State Bank of India, the largest public sector bank and largest bank as well. I think it remains our preferred pick. Amongst the second round names, I think it is more pick and choose on how one is looking at the earnings momentum. But broad, if one has to look at a broad sector backdrop, I think SBI looks much favorably placed than most other PSUs, which is why we prefer it over others.
Samir, I don't know whether you track the space, but some of the insurance companies, AMCs, are pulling out strong earnings. Anything that you like?
I will have to disappoint you there. I don't cover them directly.
Okay. Yeah. So in your pecking order, what is the 3-4 banks that you're currently buying post earnings?
Yeah. So we have a clear preference for larger names over smaller. As I highlighted, ICICI, Axis, and SBI are our preferred plays.
All right. And Samir, when it comes to insurance right now, if there is... All right. Okay, fine, cool. Maybe we can actually, move on, and you want to come in on this one?
Samir, just very quickly, did you see RBL's earnings? Market again is very disappointed with what they've done. Stock is down 10%. Now, does this become an opportunity for a medium or long-term investor to go out and buy it? And also, you did tell me that you liked what you saw with Axis Bank, and it is your top pick. You want to elaborate on the key triggers for Axis as well in the next few quarters? What could be the key growth drivers?
Well, I think growth momentum has still upside for Axis eventually as things normalize in the sector as a whole. They have significant cushion on the balance sheet, more than 1% of loans in excess provisions. And margins probably seem to be bottoming out. While there could be a rate cut, I think the impact will be felt across the industry, and you can't single out one bank over other. But generally, I think they have reasonably they have managed the balancing act between margin and growth reasonably well. So which is why our preference stays on Axis. Also, valuations were quite supportive last week, and that is why our preference for Axis. RBL, I won't be able to comment. We don't have a formal rating on RBL Bank.
Fair enough, Samir. We'll leave it at that. Thank you so much for joining us and taking us through your views on those set of banks. Of course, at the moment, we are looking at, well, I would say, at least as far as the indices are concerned, advancing marginally. But we don't have too much to speak for, except for something like an HDFC Bank, which is, I think, single-handedly leading the advances when it comes to the Nifty as well as the Bank Nifty, because HDFC Bank is up 3%, and there you have it. About 83 points out of those 136 points that you're seeing on the advance, on the upside, is basically, well, HDFC Bank. But with that, let's shift focus to Hindustan Zinc. We have Arun Mishra now, who's joining us to tell us about how the quarter's gone by. Mr. Mishra, good morning and thanks so much for joining in. Let's start off with your view overall when it comes to the pricing environment going in. How have things panned out here, specifically when it comes to zinc, because that's where we've seen an increase there. We've seen a considerable increase in silver as well. How are you assessing the demand in, supply environment?
No, our pricing, if we look at, let's start with silver. The silver prices will remain, and I had predicted about $31, $32 per troy ounce by December, which has already happened. This is primarily driven by more and more industrial demand for silver, with the push for renewable power all over the world. Solar panel manufacturing needs a lot of silver component in it. So that will continue, and there is short supply on silver as well. So it will continue, and we will see the prices remaining at $32 per troy ounce kind of range going forward as well. Whereas zinc is concerned, yes, my take was by December it should reach $3,000 a ton. It has reached before that. My calculation was based on it will happen after the US elections are over. So now after US elections, that delta of $100, $200 must get added to it. So we should see by January the prices going forward further by about $3,100 or $3,200 a ton. Hope it happens then.
Right, Mr. Mishra, what are the factors that you're attributing to in terms of expansion in operating margins? How much of this is pricing and how much of this is curtailed costs from your end?
Although while price is not, if you look at this year H1 versus last year H1, the prices are not so much, slightly better, $2,800 average price per ton this year compared to $2,500 per ton, about $300 increase. At the same time, we have cut the cost as well on H1 to H1 basis from $1,170 per ton to about $1,090 per ton. So we are working on both our volume as well as our 5% increase in volume, cost reduction. So altogether, yes, both sides it has gained. Because of that, you are seeing a reflection on our margin increase.
Mr. Mishra, can you also talk to us about the significant boost in operations when it comes to production of silver? Are you also expecting this momentum to sustain going forward?
No, it should remain around that because it may fluctuate, go down to 31 and then increase. That's okay because there are beyond a point, if the prices keep increasing, then it starts affecting the demand itself. Right? All said and done, globally, about 35% of silver goes into personal consumption, jewelry consumption, and in India, about 60% of the silver goes into jewelry consumption. So that sector may give a pushback to price, and so I don't see it is going beyond $32 per troy ounce. It will remain there only. As far as production is concerned, yes, we have done well, and this first half we have produced about 350 tons of silver, which is slightly 10 tons lesser than what we produced last year at the same time. But also we were affected by slightly lower grade in our SK mine, which is the most silver producing mine, and we hope that in the next set of 2 quarters the grade improves and we will see better production so that we can live up to our guidance that we had given to.
Sir, where do your current capacities lie? What about current utilizations, and if you have plans for them going forward in terms of expansion?
So our capacity is about, from the smelter, is about 1123 thousand tons, so about 1.123 million tons. but it has never been tested. So this year we are planning that we should go close to 1.1 million ton. So let's see. Otherwise, if the current production level of 524,000 tons in the first half, if we just double that itself, it is about 1048. But we will do better than that. So we will go close to 1.1 million ton. Then we have to do debottlenecking to take it to 1.2 million ton.
Right, Mr. Mishra, your investor presentation also mentions a foray into zinc batteries, and a gigafactory has also been spoken about. So can you tell us about the rationale behind this and plans for this going forward?
No, we are ourselves directly not getting into battery business. We have done the tie-up for getting the zinc battery technology into India as a replacement of lithium battery that everybody is so ecstatic about. We are looking to tie up with battery manufacturers in India and kind of facilitate setting up of a gigafactory for production of zinc batteries for data center applications, for renewable energy storage solutions. So for India, which should be a big market, and we can ensure that in this new application we remain the supplier of zinc.
So also, what we notice is your short-term borrowings has doubled at around 9,400 crores, pardon me, against 4,200 crores back in March. Are we attributing this largely to working capital requirements? What are the other factors here which have led to this increase here?
So there are cash mismatch issues. So we had to give dividend to, and also we have our investment locked up in long-term investments. And we are a AAA rated company. Sometimes it works out better that we take low debt and fund our capex projects. So yes, this cash mismatch issue, net debt will be around today maybe 5,000 or 5,500 crores. Not a big issue for us because we are likely to produce about another 7,000 crores kind of a number. In H1, we have done an EBITDA of 8,100 crores. So H2 EBITDA should be much better than that. So after paying for capex and all that, providing for 6,000-7,000 crores is not a big issue for us. We are not worried on.
Right. Sure. So also, given China's stimulus measures, as well as what we are noticing in inventories when it comes to LME warehouses, what can we expect from key metal prices over the course of the next 3 to 6 months?
Primarily, we are a domestic market player, so we trust India's GDP growth story, and I am sure that Indian economic growth would be more than 7.5% year on year. If that continues, Government of India's push for spending more and more money on infrastructure, the increasing middle class, their ability to buy more and more auto, and Indian auto manufacturers exporting to Europe. Given all that, we are a domestic supplier, and we see no reason to slow down, or we see no reason of any lack of demand in India. As far as global is concerned, our market is mostly around India only, which is Nepal, Bangladesh, or Southeast Asia, and we are doing well there, and we see there will be positive growth in that side. But overall, if you see global economy scenario, then China stimulus package, China growing well, China becoming a net importer, China consuming more and more zinc for their own domestic demand, it's a good story for rest of the world, so that the prices will go up. US economy is very important, and if US post-election, their push for infrastructure continues and their push for green economy continues, then world over there will be a buoyancy, and we'll find the zinc prices will also go up along with other metal prices like copper, silver, and all that.
So my final question then is about the solid expansion in your operating margins. Do you expect to sustain these levels going forward?
No, so we have done well in our managing our cost, and that is one action was consuming more and more domestic coal. Our domestic coal percentage has gone up to about 47%, which earlier used to be mere 10% or 15%. So that has reduced the cost of power generation. Our renewable power component in the power mix has gone up from 8.5% to 14%. It is likely to become 23% next quarter, then 30% by year end. So all that is adding to net reduction in cost. and that will continue. As far as we are able to control the cost, rest prices remain stable, our margin will also be stable, or our margin will increase only going forward.
Okay, Mr. Mishra, we leave it at that. Thank you so much for joining us and taking us through the quarter gone by, as well as what we can expect going forward. A very strong quarter for Hindustan Zinc, and the stock is currently up around 1%, and perhaps on expected lines as well. This is even as we see weakness when it comes to a lot of your other counters in the broader markets. Moving on, we are also taking stock of a handful of finance companies and keeping up with the earnings conversation. L&T Finance is also in focus, where the net profit has risen 17%, and the net interest margin guidance, on the other hand, has lowered. And my colleague Harsh Sehta has caught up with Sudipta Roy, he's the Managing Director and CEO at L&T Finance, to decode their Q2 earnings and outlook going forward. Listen in to a slice of that conversation.
Yeah, so, as you said, there have been some systemic/sectoral challenges in terms of asset quality, primarily in the microfinance sector. And obviously, in post the general elections and the heat wave, we had seen some weaknesses also in sort of the unsecured lending. I'm talking about the industry, the unsecured lending industry, as well as, some adjacencies in two-wheelers as well. However, the fact is that in Q2 also, we saw certain headwinds with regards to the microfinance sector. And I'll be very quick to point out that though majority of the industry headwinds, from whatever news which is available with us, what we track, is primarily because of customer leverage issues, but our sort of problems have been lesser of due to customer leverage issues, but primarily more due to sort of environmental impacts like the once in 60 years sort of flood situation in North Bihar, the flood situation in South Bihar, as well as, in some states, some of the temporal disturbances that were brought about by the stoppage of the social benefit flow for a couple of months on the backdrop of the general elections. So overall, our sort of collections efficiencies have held reasonably well, though there has been a 13 basis points deterioration from June to September in terms of collections efficiencies. We came in at about 99.43% in the month of September 2024. And I do expect that, sort of the weakness to continue into the month of the quarter of October, November, December from an industry perspective. Other businesses, what the deterioration that we saw in Q1, especially on the backdrop of the general elections and the heat wave, that took time to stabilize. It has stabilized in Q2, and we expect that during the festive period, the situations will improve. So overall, yes, a tough quarter, a mixed quarter. But again, what we have done during this quarter is to make sure that our credit engines are furthermore sharpened. As you are aware that we sort of operationalized our three-dimensional credit engine Cyclops last quarter, and we have continued to scale it up this quarter. 55% of our two-wheeler sourcing is coming in through that particular engine, and the initial trends are good. The net non-starters for our Cyclops underwritten portfolio is 125 basis points lower than that done by the legacy algorithms. So though it is in a beta stage, we remain very upbeat about the performance that is coming out of it. So yeah, overall, tough Q2. I think it will be a tough Q3 as well. We have to be cautious, and we have to place every step with an extreme caution. But again, the focus on growth momentum and a risk-calibrated growth momentum will continue with a completely tight control on risk, or portfolio origination, as well as portfolio monitoring.
Sure. So where should credit costs therefore lie in your viewpoint? You've got a good lens as to how things are playing out geographically as well. So 2.5 to 3% roughly being the credit cost H2, is that something that we can expect?
See, without going to specific numbers, the way we have sort of guided the markets is that our credit cost plus OPEX as a block will come in at about 7%. right? So if you see this quarter, we have had some efficiencies in our overall OPEX. We had come in at 4.17% of book. The credit cost went up to about 2.59% of books, but overall it remains well below that 7% threshold. So, our focus on collections will remain in Q3. We will try to see, how best we can do in Q3, whether we can better the numbers than what we have done in Q2, even though sectoral challenges remain. However, what we will try to do is that the credit cost and the OPEX as a block, we will try to contain within 7%, as guided within 7%, which might mean that we might have to tighten our belts on the OPEX side. So, if, for example, if we see that, there might be a couple of basis points spillage in credit costs upwards due to the sectoral challenges. However, our objective will be to make sure that we continue on a holding pattern.
So where within OPEX are you, trying to taper and trying to control as we are seeing a bit of a spike with regard to where credit cost is concerned?
See, obviously, some of the the calibrated expenses, like expenses on above the line marketing, or making optimization in our technology expenses, especially our cloud costs, as well as barring collections, maybe trying to see if we can optimize our hiring trajectory, etc. So we have several levers which are available with us. So obviously we are working on making sure that we build certain efficiency in our OPEX line, as well as continue to invest in collections. I would like to say that though during the period, we actually have significantly beefed up our collections infrastructure. In the rural business finance or microfinance vertical, we have put in almost close to 1,000 additional people in collections. We have beefed up our collections in our two-wheeler business. We have beefed up our collection strength in our tractor business. So overall, we have invested in our collections business just to make sure that our credit costs remain in a predictable trajectory, as well as on the overall, we have made sure that, our OPEX remains in control, so that we are able to guide and come within that 7% block of credit cost plus OPEX.
Okay, there you have it. Well, that's the management of L&T Finance, but we move on and talk to Kamlesh Shah. He's the Group CFO of Elecon Group on the back of earnings. And let's take a look at Elecon Engineering and how things are faring there, as far as the stock is concerned. And of course, it's certainly been a mixed quarter. It does seem like that. But Kamlesh, coming on your own view on the quarter gone by, what is your assessment? What can we expect going forward based on the kind of traction that you have seen on ground?
Yeah, good morning. So far as this quarter is concerned, yes, we understand this quarter is muted compared to what it was there the last year, the same quarter. But it is all because of certain consequences of the election outcome. Because mainly our engineered product, which is having the manufacturing cycle of 3 to 4 months, we started getting the order in the month of July, August only. So which could not be converted naturally because of the cycle time of 3 to 4 months. So which you will get converted into Q3 anytime. And we are quite sure whatever we are given the guidance for this year, and for both revenue as well as EBITDA, we are confident to achieve the same.
Can you please reiterate your guidance as well for this?
Yeah, this year guidance is 2,225 crore of the consolidated revenue, and my EBITDA we are expected at 24%.
All right. And in terms of power transmission and material handling, I believe those are your largest segments. What are the trends that you are currently noticing for your company, and how will they make a contribution going into the next couple of quarters?
If you see the manufacturing cycle is shorter. If in case of my catalog product, which we generally understand as standard product, when the manufacturing cycle is 15 days to 1 month only, and the engineer product, which is there, the manufacturing cycle is 3 to 4 months. The traction is now coming because the shorter manufacturing cycle. We may have some delay in the getting the order from the customer, because customers are quite well aware about my deliverables commitment and all our other terms and conditions which we are following. So we don't foresee any kind of challenges going forward in Q3 and Q4 for us.
Okay.
And so far as the material handling equipment are concerned, where the manufacturing cycle is up to 12 months, because presently, as we are aware, we are only on my business is only for the supply of equipment. We are not in the turnkey business. So with that, we are getting the orders quite early. because where the drawings are making the drawing, getting the approval from the customer or its consultant is quite critical. So that's the reason we are getting the order early over there.
All right. Kamlesh, can you also tell us about the order book? I believe that we are looking at an 18% increase in your order intake. Also, your open order book stood at a little less than 1,000 crores. What are the expectations going in, and what kind of traction are you seeing here?
Yeah, here the traction is quite good, both in the material handling equipment division as well as for the gear division. So gear division now, where my manufacturing cycle is quite shorter. Even all my customers, both in India as well as overseas, they are aware about my deliverables otherwise. So the flow of the order will come in that line only. And whatever the orders I'm getting so far as the gear is concerned, it is deliverable maximum within 4 months if it is an engineer product. And my catalog product is I'm able to deliver in the same month in which I'm getting the order. So with this kind of things, whatever the order book positions are there, it is quite good for me to achieve my target for the year.
All right. At the moment, if I'm not mistaken, the gears, contribute to a nearly 80% of your revenues. Yeah, and material handling is about 20-odd%. Is this, is this likely to shift, or is this mix likely to remain the same going forward?
On a quarter-on-quarter basis, naturally, it will have a shift because now I'm getting the good traction from material handling equipment divisions. When material handling equipment division, it is where I'm just doing the invoicing or billing to the customer on a milestone basis. So as I'm completing and whatever the portions are there, I'm able to get the invoicing to the customer. Whereas in case of the gear, I have to do the invoicing to the customer when I'm completing the entire gearbox. So that is how the things are happening.
Okay. All right. Well, there you have it. And a final question on how we are looking at commodity cost develop. Because Kamlesh, what we are seeing is ever so slight uptick in a lot of your key metals. What is your observation here, and do you think that's something that could work against your company?
So far as we know in the post-Diwali, we are expected the metal price, particular steel, because most of my products are based on steel, direct steel or steel-based product. So we expect some increase, nearly 3 to 5% increase in the steel price. But we are well protected so far as my increase in the price are concerned, because my offer to the customer or my any terms to the customers are very clear on this part. And my offer to the customer is not valid for more than 50 days in case of the standard product, and not more than 30 days in case of the engineer product. So in that kind, we are quite well insured myself against the increase in the product price is concerned. That is my raw material.
Okay. All right, Kamlesh, we'll leave it at that. Thank you so much for joining us and taking us through the quarter gone by. And of course, with the expectations of substantial improvements in performance as well, of course, we'll continue to keep an eye on that one. And thank you once again for giving us that update. But want to address PNC Infra. Now, this one is down significantly. And from what we understand is that Saturday we had an update where the management put out a release suggesting that MORTH has disqualified the company from participating in any bids for a period of 1 year. At the moment, the linkage is ongoing with respect to SEBI investigations pertaining to a specific bribery case. And because of that, it does seem like we are going to see PNC Infra enter into some considerably challenging times. And it's been a tough one because if you are an investor in this company where you're taking a knock of around 20% already this morning, while earlier on in the morning there was a little bit of a chance to exit, but now it does seem like it's going to be a tough one. There's a potential of this to be followed by a little bit more weakness coming through over the course of the next few days. Should we not see any further updates as far as PNC Infra is concerned. We also have, in fact, a note from GM Financial on PNC Infra, and they've downgraded the stock to hold from a buy. They say they've set in a price target of around 410 against 560 earlier, but this stock price is well below that mark, that price as well. And they say that the pace of incremental order inflows, naturally will slow down. This is, of course, on expected lines. They're also looking at a cut in order inflows estimates, And this will be to the tune of 8% in FY26 and nearly 19% in FY27. And on account of this, they have also gone ahead and lowered their price to earnings multiple from 15 times to 12 times, given the disqualification and muted earnings growth. So that's as far as your GM Financial is concerned and their view on PNC Infra. But let's move on and talk about a handful of other names too. Case in point, Tech Mahindra. Well, we are looking at a steady revenue growth coming in. The profitability has also beaten expectations. But all in all, of course, we are keeping an eye on several other factors. In general, their other income has seen a substantial increase, and which is why we're looking at net profit rising by around 47%. And margins have also improved sequentially. And while attrition has been has seen a little bit of an increase as well, it does seem like that's something that can be curtailed, and we've seen the strength coming through as far as Tech Mahindra is concerned in today's day of trade, one of the few gainers today. But on to some other earning candidates which are also buzzing in trade. Harsh now joins us to give us an update on that one. Harsh, over to you.
Well, let me first start off with Lombard. They came in, they spoke about how they're guiding for a combined ratio of sub 102% by the end of FY25. So that guidance does not change critically. And that's the one key positive. And this is despite the combined ratio going up to 104.5%. Combined ratio technically indicates the loss within the premiums that the general insurer earns, and basically the loss ratios seem to be shrinking overall, and that's what's really leading the combined higher. You're also rather seeing a higher expenses of management as well as a higher commission expenses, and that's likely keeping the combined ratio elevated. Switching focus a little bit to L&T Finance, credit costs continue to be higher. They're expected to be even higher in Q3, but they've guided for OPEX including credit cost. So OPEX plus credit cost to the overall asset basket at 7%. They don't expect to exceed that. So that guidance remains critical to see whether they can do that in Q3. Mr. Roy spoke to us, who's the MD CEO. He said that Q3 will likely be the top where credit costs is concerned. So probably the worst with regard to credit cost will come through in Q3 for L&T Finance. Last off with regard to Jio, elevated costs on the OPEX side, keeping that one under pressure. You're seeing almost 100% increase with regard to expenses, both staff as well as other operating costs, and that's likely impacting profitability, which was muted when you're looking at the year-on-year number. You're looking at overall year-on-year growth on top line to be around 15%. So that's the one positive. But you're seeing staff and OPEX keeping a lid with regard to where PAT is concerned. Just a 3% year-on-year growth where PAT is concerned. 80% sequential rise in OPEX. Sequentially doubling of OPEX on a year-on-year basis.
All right. Harsh, thank you so much for joining us and giving us those updates with respect to some of your financial names. But I'm going to take stock of the markets right now. And at the moment, it does seem like we are looking at a lot of weakness when it comes to the broader market. So, but firstly, let's pull up your small cap and the mid cap indices and take a look at how things are faring there. In general, of course, there is weakness. The mid cap index is down around 0.4%. The small cap index is also down by a little deeper, down by as much as 1%. And, the advanced decline ratio is not favorable at all. We have one gainer for nearly 4 losers as far as the Nifty 500 is concerned. Well, about one gainer for nearly a little over three losers in the broader markets too. And, if you just consider some of the big movers here, sure, we've spoken about PNC Infra, but India Mart Intermesh is down around 17%. What a knock this one is taking as well right now. It hit a lower circuit earlier on in the session, but then onwards, of course, we did see a slight bit of recovery. And besides that, RBL Bank is the other one, which is down around 13%. Tata Consumer Products also looking at a knock of around 9%. But on that note, it's a wrap on this edition of India Market Open. Stay tuned to NDTV Profit as the network takes a giant leap forward with the formal launch of its new channel, NDTV World. Prime Minister Narendra Modi will inaugurate the channel and offer his thoughts on how this is indeed India's century. The NDTV network has grown from strength to strength, offering the best in unbiased and thoughtful journalism. And NDTV World Summit, which is being held in Delhi, will be graced by dignitaries from across the seas. Former British Prime Minister David Cameron, as well as Bhutanese Premier Dasho Tsering Tobgay and market guru Mark Mobius, Nobel laureate Paul Rome, as well as our own External Affairs Minister S. Jaishankar and Sunil Bharti Mittal of Airtel, among many, many others. So do stay tuned for all that coverage. We slip into a short break and we'll be back in just a bit.